Hello again, my friends. Welcome to the Money DNA podcast. We are your hosts. I am Dale,
And I am Andy.
and we are here to help you ditch your debt, build unbelievable wealth, and help you to live the life that you were born to live. We want to talk about all things money, maybe not all things, but some things money, enough to get you started. We
Right.
want to make sure that we give you some concrete strategies, some good questions to help you, to help guide you along your way in your money journey, whether you're making $2,000 a year or $2 million a year. These conversations can apply, and
Yep.
oftentimes they do. So, without
Right.
further ado, let's dive into it. For the
All right.
last, yeah,
Yeah, I was gonna say we've been the last series a little bit, right? We've been talking about the birthday cake and the different levels of that birthday cake. So we have come to the top, the tippy top of our birthday cake. So just as a quick
woo,
reminder, a little celebration, right? So the birthday cake really starts with protection, but we mention this cash flow and bills paid because nothing really works if you're not cash positive, right? So once that is established, then we have our protection layer, which we're going to refer back to. That it's fun that we end on investment because it's going to relate back to all these other ones, and we're going to see how they're kind of commingled and interrelated there. Debt management, need to be out of debt or working towards that, build up that emergency fund. And then today, the one that probably most people thought we would have started with, we're going to save the best for last, and we're going to talk about investments. Doesn't fit, but you get the idea, right? So there it is. We're talking about investments today. So lots of different ways we could go on this one, and I'm sure that we could probably spend we could do a whole podcast just on investments, but we're going to just give you the introduction here. So, Dale, what do I invest? That seems like an odd question, but I think it's worth starting there because it may not be the straightforward answer that people think it is. So, what do you think?
it
What do
is.
we?
Yeah, I think it's a really helpful place to start. I think we obviously there are whole podcasts about investments and investing your money. But the reality is that money is just one of the various things that we can and we do invest, right? Um, and when we say money, we are talking about like cash, actual money that you have on hand, right? How much money can you invest? Other things you could possibly invest are your assets, other assets that you have. Some people think that your baseball cards are assets that you can possibly invest, or you bought baseball cards hoping that they're going to quadruple or 110x, 100x their value
Mhm.
in a certain period of time. Same can be said about comic books. Some
Right?
people hope that their houses are going to go up in value, although maybe that's a little bit dicey in this particular real estate market. Um, we invest our time. You
Mhm.
talked about this. The reality is that you are not actually banking time somewhere, but time is actually talking about your energy or your effort or your focus, right?
Mhm.
So where are you putting your time and attention? Where are you putting your energy, your blood, sweat, and tears, as some people like to call it? Where are you putting that effort, right? Um, and another thing, I mean, we maybe we won't have the time to get into it, but something that we are building up and investing in some sense, is our credibility, our reputation,
Mhm.
right?
Mhm.
Maybe you've had a massive change in your business and it's gone south. You could have also built up your credibility, built up your network, your Rolodex, if that's still a thing, your Rolodex of
Mhm.
contacts, and you could hit up all of your contacts and be able to start something new because you've built up that credibility, built up that reputation, built up that trust with other people that you
Right.
can then again use that and leverage that to be able to grow your wealth in ways as possible. So
Mhm. Right.
yeah, I would say as much as we don't think about these other types of investments, or as much as it's not in the conversation nearly enough, do realize that we do invest in ourselves. I mean, we're taught as youths in school, right,
Mhm.
to invest in yourself.
Mhm.
And I mean, Warren Buffett will say it, Dale Carnegie, made his entire name on this whole thing. I can't think of a single person who's out there and teaching other people about self-help, not just because they're trying to get you to enroll in their courses, but really the first thing that we always should invest in and prioritize investing in is ourself, right?
Mhm.
And if all things go south on your business investments, your asset investments or something, you can always fall back on your own investing in yourself, your communication skills, your capabilities, your credentials, your education and the skills that you have. These are all marketable things that you could possibly use to be able to grow wealth, make money, trade your skills or your value for money, build up other people's value by you've invested in yourself enough to be able to know how we can build other people's value in a credible way that they are willing to pay you money for that, right? This
Mhm.
is this is the most, arguably the most important investment that we could possibly make. Certainly a
Right.
good place to start. Yeah. What do you think,
Right.
Andy?
No, I completely agree, and I do think that and that's why we wanted to start with that is that rather than jumping into just numbers and figures and alphabet soup of 401k and this and IRAs and whatever. I mean, all that stuff is valuable, and we'll touch on all of those. But just I mean, we talked about it right here. Skills, mindset. I mean, how many times have we reverted back to the idea of all of this money stuff, this finance stuff really kind of starts and ends with your mindset. Are you in it for a quick buck? Are you understanding that this is going to take time? All good things take time. I saw something I thought was really interesting, and we'll talk about both the power and the curse, I guess, of compounding interest. But I thought this was crazy. Warren Buffett's about to retire as of the recording of this one. And I saw a thing the other
Hmm.
day that he earned 99% of his $150 billion, I think, after the age of 50. How crazy
Hmm.
is that? I mean, just imagine how wealthy he would have been if he would have applied those strategies at 25 or 30. It's crazy. So, I mean, I say that not as a saying, oh, you can just wait and invest later. I think he is a unicorn amongst all of us, right? But the idea of that mindset of just applying those skills and those practices, understanding that it is a process that you have to work on that. So, anyways, yeah, I think it's a great place to start, and we need to dive into the money aspect and how we do that, which is another question we'll ask in a second. But yeah, I think it's a great place to start.
Yeah, I think piggybacking on, is that a real word? Even piggybacking on what you're saying,
I know
Andy.
what you mean.
Um,
I think it is.
I think, I think oftentimes we are so caught up in trying to find the right gold nugget of information that we think
Mm-hmm.
is going to be like this key that unlocks
Right.
millions of dollars of wealth. It's like we're living in some kind of a game show existence or something. If we choose the right door number one, two, or
Right.
three, and
Mm-hmm.
if we somehow have like the right information or make the right guess, then it's going to unlock billions of dollars worth of fortune
Mm-hmm.
or something for us. I
Right.
don't think life really, at least it
Right.
hasn't worked that way so far for me, Andy. I don't know, maybe it's worked that way for you. And for somebody else listening, if it does work that way for you, and I would love for you to hit me up and tell me, what how I want to hear that story.
Right.
Um, but I do think that having the right questions to be
Mm-hmm.
able to guide our thoughts, to guide that mindset. Even if we're at a loss of like what is the right mindset that we should be having or not be having, I'm not 100% sure there's one answer that fits for
No.
everybody, but having a great set of questions to be able to guide our focus toward the direction in alignment with whatever things that we want to do, I think that really helps. And
Mm-hmm.
I mean, I think we are onto something here, Andy, in terms of like using questions to be able to guide our conversation, at least on this particular format.
Right.
I think it can help not just for us here, but I think it can help on our day to day in the seasons of our life
Mm-hmm.
as we're asking these bigger questions. Then, yeah,
Yeah.
asking the right questions of ourselves.
And I agree with that. And I think, again, it's just kind of callbacks to previous episodes where we continue to harp on and just encourage and implore people to ask the right questions, find a person that you trust, and then lean into this. I mean, again, we have so many great conversations. We need to have like a pre-show recording of all all of the fun things we get to talk about. Um, but it's just this idea of leaning into that, like asking those hard questions, being okay, talking about why do we need protection? Well, it's because at some point or another, it's not if it's going to happen, it's when people pass away, when they get sick, when this kind of stuff. So again, I realize that we don't need to go all the way back to protections, but asking the right questions, leaning into that, finding someone that you trust, and then moving forward with that. I just had my first in-person class talking about financial literacy and getting out of debt and this kind of stuff. And what I started with was saying, knowledge is not power. Application of knowledge can be power, but just knowing something in your head is not going to move you anywhere. So, what do I invest in? You invest in yourself, and then you invest in the action of moving forward and doing something about that, right? Just knowing, numbers and that kind of stuff is not going to make you wealthy. You have to actually take action and start working on that.
Yeah. Sometimes decision and taking action is a big commitment. It is an investment in and of itself,
Right,
right?
right,
Like you say, you can have the greatest insight, the greatest tip, the greatest information in the world, but if you are afraid to take action on it, if you're afraid to implement on that intention, on that insight, then it's meaningless. It has
right,
absolutely no potential. It's only potential, and it's all unrealized potential.
right.
So taking the leap of faith, taking the risk that maybe it's a risk, right? It's a
Hmm.
risk that's worth taking, and oftentimes taking action on these insights that we have is the investment that we need to make for ourselves, knowing that it's going to be worth it, that our
Right,
future selves or whoever that we want to bless, they will bless us. They will thank us
right.
for taking this action in the
Hmm.
direction that we know we should be taking. That's
Right,
calling to us. Something's calling to you right now. Whatever that is, don't ignore it. Take action. Right?
right.
Take action.
Right. So, and this probably should have been first, but listen to that trusted advisor. And then when you hear, good, solid advice, take action on that and move forward. So let's shift gears if we can and just kind of move forward with the idea of, now we know that, we're investing in more than just it's more than just a monetary thing. We're investing in our mindset, we're investing in our growth, right? Mindset. What's the word? Growth mindset, right? That idea of growth mindset. So
Mhm.
now where do we invest? And I want to get back to some numbers. I mean, this is a finance show, so we want to talk a little bit about numbers, but I don't know if now is the right time to talk about the pros and cons of this idea of compounding interest, because the sooner you can start gaining interest, the better off you are, and the faster you can start and you can stop paying interest, the better off you are. So do you want to dive into that aspect of things, Dale?
Before I dive into that, this is the
Right.
best time for us to dive into shameless self-referential plug.
Let us
If you're
do
going to invest your time, your energy, and focus on any particular thing, and if you want
it.
to direct anybody else's time, energy, and focus on the questions that matter, on conversations that matter, please tell other people about this conversation. Have better conversations with other people, have better conversations with yourself. If you don't know where to start, then come over to our podcast, send people over to this podcast, to this show. And he's got a couple of other links for his Empowered Wealth Solutions and for his own podcast. We would love, love, love to hear from you, to be able to engage with you, to serve you with better questions, with any sort of guidance that we are allowed to give you, that we are able to give you. And hopefully we would love to be able to build up your belief and your clarity in terms of your strategy on how to build your wealth, how to move out of debt and
Hmm.
be living a life that is unfettered from all these other shackles that we might
Right.
be struggling with
Hmm.
into the fullest life
Right.
that you can imagine for yourself.
Yep.
Yeah.
I love it. Couldn't say it any better myself. I mean, it just again, it's all kind of I keep thinking about back about other conversations that we've had in the past and the first couple episodes where we just talked about the why is it that we're doing this? We are insanely busy individuals, right? But we do this because we are confident and we are hopeful that some of the conversations and some of the dialogues that we're having right here spark something in your head, implore you to kind of move forward on this or start asking questions. And again, this is we're trying to light the spark for you to move forward into a better future. So to Dale's point, share this, engage with us. If there are questions that, like you talked about this, what did you mean about that? We're happy to engage with you on that. So yes, perfect timing, sir. Never a bad time to do a little shameless plug.
Right. So Andy, compounding interest. You mentioned it a couple of times. We touched on it briefly last time, and we should clarify ourselves. Um, how does compounding interest work, and what is this rule of 72 that you mentioned last time? Um,
Yeah.
maybe we can give a
Let me pull
quick.
up the image. Yeah, yeah, we have a little image to kind of show this off, and then I'll let Dale kind of speak through this. I'm gonna go off camera here so I can make this nice and big for you guys to see right here. But all right, Mr.
Yeah.
Dale, tell us about the Rule 72.
So, Rule of 72 basically says it's not a law, so to speak, a financial law, but it is a easier way to be able to understand compounding interest and the power of compounding interest, um, quickly, and to be able to put it in terms of time, its relationship with time. Very quickly, the rule of 72 basically says you can estimate how much something how long it will take for something to double at whatever given interest rates of increase that we're evaluating, right? So in this particular example, we're comparing 1% interest growth, 4% interest growth, 6% interest growth, and 10% interest growth. If it was simple interest, then if we had $100 growing at 10% simple interest, then every year it's just going to keep adding $10 to the total that I have in an account, right? So after 1 year, then at 10%, then I would have 110. After 2 years, I'd have 120. And after 10 years, I'd have $1,000 for simple interest. Compounding interest doesn't work that way because every single time you do that calculation of 1, 4, 6, 10%, whatever that interest rate is, then it's calculating from the new total of whatever you have, right? So after 1 year, if it's at 10%, then you're going to be adding on another 10% on $110. And you can see that 10% on 110 is going to be instantly bigger than 10% on just 100. And that grows like a hockey stick. It kind of like looks for those of you who don't necessarily know hockey, it's somewhat of an L shape like this. L shape like that growth. It's going to kind of go slowly at first, but it goes up really, really fast. Fantastic. If I wanted more concrete numbers, a little bit easier way to visualize. And let's take this rule of 72. I take the number 72, divide the number 72 by my interest rate, and that is going to give me the time it will take for whatever amount of money I have in the account to double. Okay. So if I have $10,000, as this example is showing you here, in my account, and it's growing at 1% interest rate, then it's going to take 72. 72 divided by 72 is a 1. It's going to take 72 years. Sorry, 72 divided by 1 is 72. So it's going to take 72 years for that amount to double. Okay. If I have it growing at 4%, I've got 72 years divided by 4, that's 18 years. That means it's going to double every 18 years. So after, well, in this case here, this is showing starting from the age of 29. Oh, how I wish I was doing this at 29. Then after 18 years, I'm 47 years old. My $10,000 has grown to 20,000. And by the time I retire at 65, it's now grown to $40,000. That's smart. Well, what happens if I put that same $10,000 at 29 years of age in an account that's growing at 6%? 72 divided by 6 is 12 years, so it's going to double every 12 years. That means at 29, sorry, at 41 instead of 47, I've got my $20,000. And then if you keep that going by the age of 65, I now have $80,000, right?
Mm.
I'm going to do this one last step. If I had $72, 70 at 70, yeah, $10,000
Mhm.
and it's growing at 10% interest, then now my doubling rate is 72 divided by 10 is 7.2 years, just over 7 years for that money to double. I start off with my same $10,000 at the age of 29. By the time I'm 65, that amount has grown to $350,000 estimated, not
Mhm.
exact numbers, but just a rough estimate. That is significantly more than if I parked it at a 1%, you know, oh, that $20,000 is at 101. That's not even close. I'm nowhere close. And take a note of that. If I wait another 7 years after that, then I've got over $600,000 starting from that same $10,000 we started from at age 29. But instead of sitting it at 1, 4, 6%, it's at 10%. This is single digit differences between these
Mhm.
percentage points, right? But it is a massive, like you say, Warren Buffett making 90% of his money after a certain point. It makes total sense because of the way exponential growth or compounding interest works. Because of the
Right,
way the math works, then the potential is huge.
right,
So, um, what is this showing you? This is showing you that those interest rates can make a huge difference, and it helps you in terms of like, okay, maybe $5,000 in an extra in a year's time, 2 years' time doesn't make a significant difference. But being able to see how quickly that amount can double within a longer time frame, right? Or how much more money I'll have within a certain period of time if we were to compare the two, that's what makes a world of difference. I mean, there's so many applications in terms of compounding interest and in terms of like quickly using the rule of 72. But
mm,
really, I hope you're able to see here that the numbers are just doing what the numbers are doing. This is just math.
mhm,
We're not making up. This isn't
right,
some kind of funky scheme that banks have connived or something. This is
right,
just how math
right,
works, right? And again, this isn't a hard and fast rule either. This is a way to quickly estimate it,
right.
but you're able to see some of it.
Yeah, I love it, and I appreciate that you mentioned that last statement right there because I do think that um, when people see numbers grow so quickly or debt being paid down so quickly, whatever the case is, depending on what we're working on, um, I think we are just skeptics at heart, and probably even more so with having been burned or something in the past. To Dale's point, math is math. Numbers are numbers. This is not something that we are making up to sell you on one thing or another. This is the law of that's what that's called, right? The rule of 72. It's going to work. Why not have this work towards, work for you rather? I want to just highlight this again, and I'm sure that you will back me up on this or just confirm this. This is with a one-time $10,000 investment. This is not putting in $10,000 every year, right? This is a
That's right.
one-time $10,000 investment that then compound interest starts working. And again, on this 10%, which just throwing it out there is about the average of what investments are getting back. There's going to be good years and bad years, but over time, 10% is about what the stock market will yield. So just putting it in a simple brokerage account where it can earn that 10%. Yes, you're going to have good and bad years, but um, sooner than later, growing your interest is going to make massive differences down the road. Absolutely.
Yeah.
Yep.
Yeah, I think another thing that we should just quickly mention, Andy, is that your money can make money, right?
Hmm.
Um, you have money sitting there and we take for granted this idea that cash money has a potential to do work for us. We can put the money to work and put it in somebody's hands in a place, position it so that it can grow and um, make money for you, right? And that principle of like money being put in the right place and then it growing at a better rate or a higher rate or something, that's what a lot of these other investment ideas really come from, right? If we lend money to somebody and we say, I have $10,000 in hand, but if I give you this $10,000 and if I charge you a 4% interest rate on it, then in the same period of time, that money is going to be growing at a 4% if I were to collect that after, however many years, then I'm making
Hmm.
money on that money, right? I'm
Right.
lending money to the bank by putting in a bank account. And if it's a high yield savings account, let's say, then it might be making 3, 4, 5% or something. That means after a certain period of time, then that money is growing for me. And that's what we're doing really when we're investing money, when we're putting that money to work by parking it in some kind of a long-term account, a short-term account somewhere, or we are buying, even when we're buying all these different shares and bonds and things, we're basically putting that money aside and asking that money to work for us, or asking that person to put the money to work for us so that we can so that that money will do something, right? Anyway,
Hmm. Yep. Yep. I love it. So let's get back to kind of a little bit more not practical. All of this stuff is practical. All this stuff again, talking about mindset and just knowing, you kind of have to have a baseline of information as to what's going on right here. I mean, put basically debt is where money is working against you, and investments are where money is working for you, right? I mean, that's it can't get much simpler than that. Is your money working for you or against you? That's really what it boils down to. So, and again, back to the idea of needing to talk to a trusted advisor. Everybody's situation is going to be different. What their discretionary income to be able to invest is different. Again, back to all of our previous layers, but just give me some ideas, or maybe again, not the specific avenues that we're reaching out to, but what are some questions, Dale, that someone starting off that's wanting to invest, what are some questions that they would ask to be a savvy investor to get started on this? And I think that's kind of where our next question is. Am I right? Yeah. Where do I start? We've already done our little thing there. So now that we understand that there's the need for this, how do I start? What questions do I ask? What are some things that I need to be thinking about?
Yeah. Um, like we said in the podcast before, the first question before you ask how really is who.
Hmm.
Ask who first, right? Um, when you're finding out this information, when you are investing any money, really, you need to be asking yourself, taking a stock of who you are, who these people are that you're inquiring of, but also who are you investing that money for? When if you want to grow money, if you have an objective to be able to invest your money and grow your wealth, or grow an asset of some kind, you have a house and you want to be able to build equity or build a wealth in this house, then or you're spending money in your health, you're spending your time and your investment, your effort into health. Who are you investing this money for? It makes a world of a difference if you have a clear idea of who you are investing for and how that's going to pay off for them in the
Hmm.
future or right now. So for me, I wasn't too keen on getting up early and exercising and doing stretches, all that. But all that changed when I had kids in the picture, because now I know that my health is not just for me. My wealth and my money is not just for me. This house that I'm in right now I'm not building it just for myself. I am building it for them, for their health, for their happiness, for their security, and to secure a future for them as well. So what we're doing right now, in some sense, is impacting ourselves in the future. It's
Right.
impacting our loved ones right now and in the future. So have a clear idea of
Mhm.
of who am I investing this for? It could be your future self, it could be your kids, it could be your grandkids, your great grandkids, your extended family, your parents, as often the case might be. But have a clear picture of these people that you want to invest for.
Mhm.
You're not just, paying yourself first and doing it completely for selfish reasons,
Mhm.
although there's nothing wrong with that. But you're also making decisions that are impacting a lot of other people, your loved ones, your whether you're giving it to church or charity, for philanthropic reasons. Maybe you have philanthropic motivations to be able to give away a whole bunch of money and support some other cause. Then these are really important, and they're important to have in mind when you're starting these questions.
Mhm.
Yeah. What else? What else? It's helpful to also be clear about the different kinds of investments. I mean, we talked about bonds, stocks, and shares. We didn't really break down, did we? The different kinds of shares and all that. We can get into that, but if you're investing in a business, you can own your own business. You can be a business yourself, right? You can own your own business, and that is owning 100% of a share of your particular business. You can own just if that's just you have 100% ownership of that one wee business, and you have whatever investments that you make. You can also own a small part in a very, very large business, right? Like I own a small part of Apple stock.
Mhm.
I that means that when Apple's making money, I'm making money, and that's fantastic. Millions of dollars? No, it's not
Mhm.
that kind of a thing. But and you can own a business. You can have a ownership of a business anywhere in between that scale of like 100% of a small business or a very wee percentage of a large business. You can have any mixture of anything in between. And you can be investing not just your money, but your time, your effort, your energy into these various businesses in different ways as well, right?
Mhm. Right.
realize that if you are risk averse, that it's probably not a good idea to
Mm.
have all your investments
Right.
in one particular thing, right?
Right.
You want to be able to diversify your income streams, diversify your investments to a certain degree. And you also want to diversify the types of investments that you have, right? So don't put all of your money into your house. Your house, it could be a guaranteed investment. It might for sure grow. It may not. It might crash. You might not live to be able to see when your house is paid off and all that. So if your house is your only income strategy, I mean your only investment strategy right now, then do consider other investment strategies, right? In the past, people have been investing in their job. My career is my 100% investment. I put all of it into my career, and all the money that I have, I'm putting back into my job or something, and hopefully they'll pay me a good pension and pay off that way. Maybe in the old days that would have really worked, but in this day and
Right.
age, that's not often the case now. So you want to diversify and be able to consider um, lots of different types of investments that you can make, right?
Right. Yep.
Uh,
So let's talk a little bit about, I mean, just some different, you mentioned business owners and this kind of stuff. So, I mean, there's entrepreneurs that maybe are going at this kind of on their own. They're doing their different things. So certain investment portfolios and deliveries are going to be different for people that are working on their own as opposed to somebody that's working for a corporation. So, I mean, we've got 401ks, we've got IRAs, we've got some different things. And again, I don't know if we need to go through all of the different alphabet soup here, but maybe just some big ideas of some specific names of some investments that might be good to again start asking questions about as people are getting started.
yeah. I don't know if we can get into like things being good or not.
Better fits or
But
whatever you want to call it. Yeah. Hmm.
yeah, I mean, I think maybe broadly, you can own a business, right? You can be a business yourself. You are yourself, your own business, and you are owning yourself. And you're putting your blood, sweat, and tears into growing your brand. So this applies for me. I get this as an actor. I am my own brand. I am my own business, and I'm marketing myself. I'm 100% everything that I own, everything that I give. But and that is its own market in and of itself. Going back into you can own a business. Like for years, my family ran a restaurant, and we owned 100% of the liability and the investment, all the money, the blood, sweat, and tears. We went and owned and operated this particular restaurant. You can own a part of McDonald's. That's owning a restaurant, but you may not be the operator of that particular business, right? So owning and operating, the amount of money that you're putting into it, the amount of time and energy and blood, sweat, and tears you're putting into it are not always one and the same, right? Again, you can own a share of a larger company if it's either privately owned, you are a partner in a business or you are one of the shareholders, one of limited shareholders in a private corporation, or you could be a shareholder in a larger publicly traded, exchange traded stock, right? So that would be like your Apples, your energy, telecom companies, these big things that are on these stock exchanges. You can buy a small share, a part of the ownership of this particular company, right? And so those are shares. You can also be investing money into a government or a municipality. These things are called bonds. They're not necessarily always for governments or municipality, but a lot of the times the bonds are sold by, local governments, municipal governments, state governments, or provincial governments, federal governments. Even private companies can also sell bonds, but these are ways that you can be able to invest in. They're asking for you to invest in that particular organization, and they are promising you that after a certain period of time, that we will pay you back a certain amount of money for your investment in that
Right.
particular organization, right?
Right.
And then you have your funds. A fund, you can get a mutual fund that is not just like, oh, I don't know what I should be investing in at any given time. Maybe I should be investing in IBM. Is IBM still a company? IBM
Mm.
in Microsoft. Maybe I should be investing in. Oh, I don't want to invest in. um, in this company and that company, and it's too much to keep track of. Well, you could find companies, a person to manage a portfolio of different shares, right? And this is where your mutual funds come in, or sometimes you get into what's called exchange traded funds, ETFs. Index funds are basically a pool of shares that take part. It's a fund that buys shares in, let's say, the S&P 500 would be the top 500 US companies, right? It just says these are the top 500 US companies right now, and we are buying shares in these companies, right? And it just um, it's sort of a larger pool fund, and that's how it's structured. So you can buy funds, right? You have to keep in mind that whatever you're investing in, whether it's a small business or whether it's a small operation or a large operation, or whether it is a pool of funds of various different operations, various different businesses, realize that whatever you invest in, you have to consider the tax implications,
Mhm.
and you also have to consider the fees that are involved in in your investment, right? If you're investing a whole like hundreds of thousands of dollars into a small business, that's coming at a high cost for investment, right? But it they you're not going to charge yourself any money to be able to manage that particular in investment because it's your company, right? If you're buying a mutual fund, however, the mutual fund companies will charge you a certain management fee to be able to take part in the ownership of this particular fund, and to take part of it. So that's going to cost you a little bit of money, and that
Right,
money, depending on how it's structured, they may be charging you that money whether the fund is making money or losing money.
right,
They might still be charging you. So keep that in mind.
right.
Same thing with taxes. You can be making outrageous amounts of money in whatever investments that you have, but bear in mind that you should be considering your tax implications as you go, right? There is no free lunch in North America. Like you're always going to have to pay some degree of tax. So be smart about how much money you're spending and how much money you are having to owe in the course of all these investments that you might be making. Ask
Does it
yourself.
make sense to just touch a little bit on and maybe just give the basics of like a 401k and an IRA? I mean, again, not saying one is better than the other, but just again as an informational kind of pros, not pros and cons, just differences between the two of them.
Yeah, I mean, you could speak to this a little bit more, you being south of the border than I can, but and I think we should put the caveat that this is
Mhm.
not investment advice, that
Nope,
we're not here to give you
just
financial or
informational.
investment
Yep.
advice. Anyways, we're giving information for educational and somewhat entertainment purposes.
Mhm.
But you can grow money in a mutual fund. Let's say you are buying money, you're paying, like we said before, you put $10,000 into some kind of a mutual fund and they promise a 6 or 8% return or something. Whatever money you're making in that mutual fund is not growing tax free.
Mhm.
You know, if let's say that money doubles or triples after a certain period of time, or even
Right.
your house, let's say you bought it at $100,000 and eventually you sell it at $500,000. Well, there is a capital gain. There is some kind of a gain that's realized, and whether in this side of the border or that side of the border, you are taxed on that capital gain. If it's your primary residence, then
Mhm.
you may not be taxed on that capital gain. But if it's for investment purposes, because we're talking about investments here, then you are absolutely going to be taxed on it. So you want to be doing things that are a little bit more tax efficient, and that's where this 401k and the IRAs, especially the Roth IRA, that's where really these are important to consider, right? On this side of the border, we have different names for these. But Andy, tell me, 401k, why is this a good idea to consider if you are working in the United States?
Right. So again, preface, we are just doing this from our vantage point, sharing some information, hopefully, some good things for you to think about. Talk to a trusted professional as far as like an investment professional. But again, we're just personal experience here. 401k, in my experience, has always been with a larger organization or a company, right? So this is something that is a company plan that is a It's honestly a perk, right? As you come on to this company, we will provide a company provided 401k that not only you can invest in with the mutual funds that Dale was talking about with this diversified portfolio that you've got, things that are long term, so things that are short term, foreign, domestic, all of the stuff, right? It's very, very diversified. But 401k, the advantage of that is that it's not only you putting into that, the company many times is matching that. So oftentimes, if the company matches 2%, you put in 2% of your check, they put in 2% of their check on top of your paycheck. Now you're getting 4% every paycheck that you have towards your 401k. Like we said with the compounding interest, that's going to go much, much faster. You're going to grow that double, right? Because you have that much more money coming in. So 401ks are a great thing for on the company side. Again, there's going to be tax implications as when you can pull that out. Can you borrow against it? I mean, there's all that stuff which we don't have time to get into. So that would be my 30,000 foot view on a 401ks. If you're in a company that offers a 401k, definitely try to meet where that match is. If that's 2%, 3%, because that's going to grow your portfolio that much faster. As far as how you diversify and where you put your stuff, so many different avenues and considerations for that. How far out are you from retirement? How aggressive do you want to be? There's all those conversations that you'll need to have with an investment specialist.
Yeah, I think if you were to if I were to explain this to my 7-year-old upstairs, and I would
Yeah,
say, hey, I'm
right,
going to put money here, and because I'm putting money here, and somebody else is also going to put in money there, and that money eventually is going to go to you, right?
right.
I'm, using very, very simple explanations. Um, that's a big difference. The difference
Mhm.
between like me putting in money versus me and somebody else adding
Right,
money
right.
to this particular account. So you're growing money for your future self, and you by enlisting in this particular program, this 401k program,
Mhm.
or a pension program of some kind. We have
Right,
different kinds of pensions here, but it's the
right.
same scheme that oftentimes that money will be matched by
Mhm.
your employer or some other group, or they will contribute as well to that particular money, and that they're
Right,
eventually basically giving your future self money and allowing that money to
right,
grow on your behalf, right?
right, right.
Right.
You
Um,
want to take a stab at Roth at IRAs again? There's different ones, and again, keeping in mind, guys, we don't have time to go in depth on this, but again, just kind of the 30,000 foot view of just as you're having these conversations with your investment specialist, just some questions to think about, just to give you a kind of a basic understanding of that.
I think the key thing to think about in terms of IRAs and what we have here, like TFSAs, things like this, they're not one-to-one equivalents, but really where they are being a little bit more strategic is in terms of tax efficient growth, right?
Okay.
So instead of being taxed like mutual funds, like other mutual funds, if it's just a regular fund, then there is no real tax efficiency there. Whatever money that you're making there, you're going to be taxed on. So if you sell those stocks, or sometimes even just the actual growth of those stocks themselves, then you're being taxed on that growth. Or if they're paying out dividends as you go, then you have to
Right,
treat that as income, right? Whereas
right,
an IRA, tax-free savings accounts, for us here, they are growing, and there is tax efficiency there. You don't have to pay any tax for it while it's growing. Maybe later on when you're pulling it out, then
right.
you'll be taxed later on. Or in our case, we have what we call RRSPs. I'm not
Mhm.
taxed for the entire time while I'm contributing to it. And for us here, we don't actually get taxed for the contributions. They become tax deductible contributions when we're
Right,
paying into it. But we
right,
pay tax later on when we were drawing. As when
right,
when we take out
right.
that money in retirement, it's not like we don't get paying any taxes on them. You will be taxed on them later on. And that's not no tax, but that
Mhm.
is certainly better tax schemes in some ways, especially if you're watching for it, if you're mindful of it and keeping track of it.
Right.
Slight caveat, slight little thing. A lot of people don't think about the taxes upon retirement, and they
Mhm.
are putting away all this money thinking, oh,
Right,
this is going to be
right.
great. I'm going to have $2 million in the bank ready to go by the time I hit retirement. And depending on how that's set up and how those accounts are set up, they might all of a sudden be on a really, really high tax. They have a high tax bill unexpectedly thrown at them because they have money set aside and they weren't accounting for how that money would be taxed upon retirement. So Do think about these implications. Do ask that question of yourself now so that you're not having to put your future self in a pickle when it comes time.
Right. Right.
Anyways.
I love it. So, Dale, I mean, we could probably continue on about this because there is so many different avenues and different ways that you could go about this. I'm looking at some of the notes we had before. We didn't hit on everything, but I think just grand scheme of things of, just kind of wrapping things up here of, what do I invest in? It's much more than just dollars, right? We're investing our time, we're investing of ourselves, of our growth, our mindset. Where do I invest? Like who is it that we're investing for? And then where do I start and how do I start? It's, talking to that person that you trust, taking action on that and starting as soon as possible, right? I mean, it's one of those things like even 2% starting earlier is better than, 10% in the last 5 years that you want to retire, right? So that idea of taking advantage of that compound interest growth, the sooner that you can start on this, the better. Maybe a good one to end on is the example that you had mentioned before of investing 200 a month rather than paying off a credit card at $200 a month. I think that would be good numbers to kind of run through, just to kind of bring home the idea of the power of investment compared to the crippling aspects of debt. I think that might be a good one to kind of wrap up. What do you think?
Yeah, I can't bring up the visual right now, but Andy and I we were talking about I gave this example. Andy, if you invested $200 a month, right? You started from zero, you invested $200 a month, and you're putting $200 aside every single month for 5 years, right? Then you'll have paid into that investment $12,000, but you'll also have made almost $2,000 in interest, right? Just under $2,000 in interest. So by the end of that, you're going to have a total of just under $14,000. And that's, of course, all other market variations and 6% and whatever aside. But simply, you put $200 away at 6% for 5 years, you're going to be getting $14,000 by the end of it, right? Just under, is that right? Yeah, 14,000. Yes, yes, yeah. If on the other hand, you had an $8,000 credit card bill, right? 8,000 is less than 14,000 for sure. But and the standard and you're paying into that credit card, you're paying off that credit card over the same 5 years. It'll take you a little bit more than 5 years if you're paying $200 a month, same $200 a month to pay off your credit card bill, $8,000. You'll have paid it off in just over, I think it's 5 years and maybe 2 or 3 months or something like that. About the same time frame. But by the end of that, you will have also paid $4,300 in interest. In other words, you've paid it off that 8,000 for sure, but you've also given away another $4,300, right? Almost half the amount that you owed. Same $200 a month, same time frame, but it's just showing you that somebody's getting wealthy. And in the first case, that could be you. Your future self in 5 years is going to go away with um, an extra $2,000. And I mean, if you're not thinking about that $200 a month that you're putting away, if it's automated, like we talked about in the beginning, in
Mhm.
the earlier episodes, Andy, if you're just automating it, you're not even thinking about it, then 5 years later, you're going to be surprised. Hey, what do you know? I have an extra $14,000 that I can spend as
Mhm.
opposed to automatically paying $200 a month to somebody else, to Mr. Credit Card owner,
Right.
then you've given them a handsome $4,000
Yep.
over the course of that 5 years, and you're making somebody rich, but it
Right.
better to make yourself rich, right?
Right. Right. And on that note, that is what our whole hope in having this conversation about investments is, rather than making the banks or the lenders any wealthier than they already are, let's work a little bit smarter with our money and take some of that money back to put it in your pocket and put you in a better spot moving forward. So thank you so much, guys, for checking out our Money DNA podcast. We will be back, I'm sure, and can't wait to have the next conversation with you. Thanks so much for watching. We'll see you guys soon.